There is a number hiding inside almost every middle-class retirement plan in America that should change how you think about your account balance, and almost nobody opens with it. Two coworkers, same age, same $75,000 salary, same start date, make opposite choices for 32 years. One maxes his 401k, the other goes hard on a Roth IRA. At retirement, the 401k guy has more money on his statement. Then the IRS shows up, and the math you have never seen run flips the entire story. If you are someone trying to decide between a traditional 401k and a Roth IRA, or you already picked one and have a quiet feeling you might be wrong, this is the full picture nobody puts on a single page. We are going to run 30+ years of math, including taxes, required withdrawals, Social Security interactions, and the early withdrawal penalties most calculators just ignore. You will know which account actually pays more after tax by the end of this video. Let me set the scene the way that conventional wisdom does, because it sounds clean. Jake earns $75,000 a year. He puts 10% of his salary into his 401k. That is $7,500 from his paycheck every year. His employer matches 4% dollar for dollar, which adds another $3,000. So $10,500 goes into his account every year, all pre-tax. Jake's contribution lowers his taxable income, and at the 22% federal bracket, that saves him about $1,650 in taxes every year. On paper, this looks unbeatable. Marcus picks a different path. He opens a Roth IRA. Some sources will quote the older limit, but for the 2026 tax year, the IRS contribution cap for an IRA is $7,500, and that is what Marcus contributes. The catch is that Marcus pays his taxes first, with after-tax dollars, before the money goes in. He gets no deduction. His paycheck takes the full hit today. Now ask yourself which one of these two looks like he made the smarter call. Most people say Jake. He is contributing more, getting free money from his employer and saving on taxes right now. And here's the part nobody pauses on. Jake's 401k balance has a silent co-owner that never appears on his statement. That co-owner is the IRS. Every dollar Jake put in pre-tax, and every dollar of growth on those dollars, gets taxed as ordinary income the second he withdraws it in retirement. Not capital gains rates, not some special retirement rate. Ordinary income at whatever bracket he lands in. That is one of the first things people miss about a tax break versus a tax elimination. The 401k is not erasing his tax bill. It is deferring it to a future date at a future rate on a future balance that will be much larger. Picture this. Year 10 of the experiment. Jake has been contributing $10,500 a year, growing at a steady rate. At a 7% annual return, the verified math puts his balance at roughly $145,000. Some illustrations push that number higher to about $155,000, and that requires closer to an 8.2% return. So I will use the steadier 7% figure and stay honest about the assumption. Either way, when Jake looks at his statement, he sees a number that feels like his. It is not entirely his. Apply that 22% retirement tax rate to the $145,000, and roughly $32,000 of it belongs to the IRS the day he pulls it. Marcus, meanwhile, has contributed his after-tax dollars over the same 10 years and watched them grow. His balance is smaller on the statement, but every single dollar of it is his. There is no co-owner. There is no future tax bill. The Roth's headline number is the spendable number. Skeptical? Good. You might be wondering whether the after-tax gap actually narrows enough to matter, especially with the employer match still working in Jake's favor. The match is real, and we are coming back to it. But hold the question, because the gap does something interesting when you stretch the timeline. Year 20. Jake's balance is bigger again on the statement. Marcus is behind in raw dollars. But once you apply the same 22% tax lien to Jake's number, the after-tax difference gets surprisingly close. The employer match is the only thing keeping Jake meaningfully ahead in after-tax terms. Without that match, Marcus would already be competitive. So the conventional wisdom that the 401k is obviously better starts to wobble before retirement even begins. Now here is where the story flips, and this is the part that no statement, no calculator, and no conventional rule of thumb shows you. Jake hits retirement age. He has built a real balance through 3 decades of contributions and growth. He plans to pull $60,000 a year to live on. The IRS treats every penny as ordinary income. After the standard deduction, the 2023 figure was $13,850 for a single filer. Used here as illustrative, his taxable income is around $46,000. He sits inside the 22% bracket, which the IRS set at $44,726 up to $95,375 for that tax year. his federal tax bill on that withdrawal lands somewhere around $5,100 every year for 25 years. Marcus pulls the same $60,000 from his Roth IRA. Qualified Roth distributions have been tax-free since 1998. His federal tax bill on the withdrawal is zero. That $60,000 lifestyle cost Marcus zero in federal tax. It cost Jake roughly $127,000 over 25 years of retirement, and we have not even touched the trap waiting underneath that. Here is the trap: Social Security. The Social Security Administration's rules say that for a single filer with combined income above $34,000, up to 85% of your benefits become taxable. For married filers above $44,000 combined, the same rule fires. Jake's 401k withdrawals push his combined income straight past that threshold. So a chunk of his Social Security check, money he already paid into his entire career, becomes taxable right alongside his retirement withdrawals. On a typical benefit, that adds roughly $2,400 in extra tax every year, which compounds to around $61,000 over a 25-year retirement. Marcus's Roth withdrawals do not count toward that combined income calculation in the same punishing way, so his Social Security is largely protected from the 85% inclusion that hits Jake every year. Stack it up, Jake's total tax drag in retirement, withdrawal taxes plus the Social Security inclusion, comes to roughly $188,000 over 25 years. Marcus pays close to nothing. That is the line that never appears on a 401k statement. That is the answer to which account pays more after tax for a middle-income retiree. After the IRS takes its cut on every withdrawal, after required distributions force money out whether you need it or not, and after Social Security gets pulled into the tax base, the Roth IRA's after-tax delivery often beats the 401k's headline balance, as long as the 4% employer match is captured first. It gets worse for Jake before it gets better. Under the Secure 2.0 Act of 2022, anyone who turns 72 after the end of 2022 has to start required minimum distributions at age 73. RMDs are not optional. The IRS calculates them by dividing your prior year-end balance by a life expectancy factor of 26.5 at age 73. If Jake's 401k has grown to $2,600,000, his first required withdrawal is approximately $98,113, whether he needs the money or not. That forced income does three things at once. It pushes him into a higher bracket, it triggers more Social Security taxation, and it can lift his modified adjusted gross income above the IRMAA thresholds that determine Medicare Part B and Part D premiums in 2026, which means he pays a surcharge on top of his base Medicare premium every month for the rest of his life. Marcus has no required minimum distributions on a Roth IRA. He chooses what to pull and when. There is one situation where Jake's 401k clearly wins, and you have to give the credit honestly: the 4% employer match. That $3,000 a year is not a return on investment in the normal sense. It is an instant 100% gain on Jake's contributed dollar before a single market day passes. Compounded across 30-plus years, the match alone is worth hundreds of thousands of dollars. Nothing replicates that. Now, a fair friend of mine pushed back on the greatest ROI in personal finance framing recently, and his point was right. If the 401k plan has high fees or limited investment options, the math erodes. The match is great, but it is not magic. You still want to look at the plan fees before you celebrate. You might also be asking what happens if Jake needs money before retirement. This is where the Roth's quiet advantage shows up. Roth IRA rules have always allowed you to withdraw your direct contributions at any time, at any age, with zero tax and zero penalty. Not the earnings, just the contributions. So if Marcus has put in $150,000 over 20 years and an emergency hits at 50, he can pull $30,000 out. No penalty, no tax. Jake pulls the same $30,000 from his 401k at 50 and gets hit with a 10% early withdrawal penalty, $3,000, plus ordinary income tax of roughly $6,600 at the 22% bracket. That is $9,600 gone before he spends a dime of the actual emergency. Now, an honest caveat that some retirement influencers skip: pulling Roth contributions is not free in the long run. The money you take out can never be put back beyond your annual limit, and you lose decades of compound growth on every dollar withdrawn. The Roth as an emergency fund is real, but it is a last resort, not a first move. The Roth has real limitations too, and pretending otherwise would be a disservice. For 2026, single filers with a modified adjusted gross income above $153,000 start losing Roth eligibility, and above $168,000, they are locked out entirely. The 401k has no such income limit, and its $24,500 contribution ceiling for 2026 dwarfs the $7,500 IRA limit. For a high earner, the 401k offers more than 3 times the tax-sheltered space. There is also the cost of Marcus's choice that critics rarely quantify. Marcus paid roughly $1,650 more in federal taxes every single year than Jake did because his contributions were not deductible. If Jake had taken his annual tax savings and invested it consistently in a brokerage account at 7% for 33 years, that side pot would grow to approximately $194,775. That is real money Marcus walked away from for the privilege of tax-free withdrawals later. Whether that trade was worth it depends on something none of us can predict perfectly: future tax rates. Could rates go down? Sure, anything could happen. But with the United States national debt sitting above $38 trillion as of April 2026, the structural pressure points the other way. And key tax cuts and Jobs Act provisions that set today's brackets are subject to ongoing legislative discussion. This is not a prediction that rates will rise. That would be a guarantee I am not in a position to make. It is a reason that tax diversification, holding both account types, is a hedge against an uncertain future rather than a clever optimization. There is one more dimension most people never weigh: what happens to the account when you die. Under the Secure Act of 2019, most non-spouse beneficiaries inheriting a Roth IRA must withdraw the full balance within 10 years, but if the account was open at least 5 years, those distributions are completely income tax-free. Marcus's kids inherit his Roth and owe zero income tax on any of it. Jake's kids inherit his 401k under the same 10-year rule and owe ordinary income tax on every single dollar they withdraw, often during their own peak earning years, which can stack the family's tax burden in the worst possible way. There is one edge case worth knowing. A regular taxable brokerage account receives a step-up in cost basis at death, which is its own meaningful advantage if you have non-retirement assets. But on the head-to-head Roth versus 401k inheritance comparison under current rules, the Roth wins decisively. So what do you actually do with all of this? The answer is not pick one account, it is a sequence. Step 1, contribute to your 401k up to the full employer match. That is non-negotiable, because nothing in personal finance replicates an instant 100% gain. Step 2, max your Roth IRA at $7,500 in 2026 or $8,600 if you are 50 or older, as long as your modified adjusted gross income is below the $153,000 single filer phase-out. Step 3, increase your 401k contributions toward the $24,500 limit. Holding both account types in retirement gives you something neither alone provides: control over your taxable income, the ability to keep your combined income below the Social Security inclusion threshold, and a way to manage modified adjusted gross income to avoid the IRMAA surcharges. We opened with 2 coworkers who thought they had it figured out. Jake forgot to count what the government takes on the way out, roughly $188,000 over 25 years. Marcus forgot what he gave up on the way in, about $52,800 in foregone tax savings over 32 years. Plus the employer match he never had access to. Neither one had the full picture. Now you do. If this is the kind of analysis you want on every major financial decision, that little subscribe button is how I know which videos to make next. And if you are someone with a balance already built up in a traditional 401k or IRA and you are now wondering whether you should be moving some of it over to the Roth side and how to do it without triggering a tax disaster, that is the next video on your screen. It walks through the conversion strategy that ties this whole framework together, including how to time it, how much to convert each year, and the trap that catches almost everyone who tries this without a map. One last thing, this video is general education, not personalized advice. Before you act on any of this, talk to a qualified financial advisor or CPA who can look at your full tax picture, your bracket today, your projected bracket in retirement, and tell you which step of the sequence applies to you right now.